we can see that as the price spiked from about $25, $30 to 120, and now we're still at about 85, that is specifically when the amount of shorts went to the lowest ever. So as the silver price moved higher, their shorts got lower and lower and lower. Big move up in the gold price, while open interest falls closer to the 400,000 level. If you have open interest going down and the price going up, that is the definition of a short squeeze. Doesn't mean that people are stuck, but it means that shorts are covering at higher prices on net. So we are once again in a minor gold short squeeze. So what is really happening in the planet?
If it fails to deliver, the entire system will implode. The derivatives edifice will collapse because silver will spill over to gold, and gold will spill over to the credit markets, U.S. Treasuries, etc. So if silver fails to deliver, it is not an isolated event.
The silver market is currently exhibiting technical behavior that points toward a massive structural breakout as price action aggressively detaches from traditional paper manipulation. When silver prices surged from the $30 range toward $120, a remarkable phenomenon occurred. The total number of short positions held by major producers dropped to their lowest levels in history. This indicates that the entities usually responsible for suppressing prices through paper derivatives are losing their ability or willingness to bet against the metal's upward momentum. As the price holds strong near the $85 level, the continued decline in short interest suggests that the floor for silver has been permanently raised. Rafi Farber and billholter are prominent financial analysts and experts in the precious metals sector, known for their deep understanding of market mechanics and systemic risk. They highlight that the current combination of rising prices and falling open interest is the textbook definition of a short squeeze. This rare market condition forces short sellers to cover their positions at increasingly higher prices, creating a self-reinforcing cycle of bullish momentum. For gold, a similar pattern is emerging as open interest falls toward the 400,000 level while prices hit new highs. This divergence confirms that the smart money is exiting its bearish bets, paving the way for a sustained and explosive move in both gold and silver. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Situation here, silver producer gross short positions at the lowest ever continued through the crash. So we can see here, this is the black line, the net amount of net shorts, that's short positions minus long positions, and we're here at about 15,000. The only time we were lower than that in terms of net short positions was here in about 10,000 in 2019 when silver was about like 18 or 19 bucks. I think this was near the bottom of the silver market. And we can see here that these are the gross shorts on this line over here. And you can see I drew a black line to show you that we're at 19,000. We haven't even gotten close to that level of gross short position. So what does it mean? That producers are not shorting silver, meaning either they can't do it or they won't do it because they think the silver price is not worth hedging, or they can't hedge because it's too expensive and they lose money that way. But if we focus in on this part of the graph, we can see that as the price spiked from about $25, $30 to 120, and now we're still at about 85, that is specifically when the amount of shorts went to the lowest ever. So as the silver price moved higher, their shorts got lower and lower and lower, and they are not building them back. You'd expect that if they want to hedge and when they want to lock in a big price, the producers, they would short more contracts at a higher price so they can lock in that price, but they haven't done it. Why not? Because hedging is impossible. It's not profitable to hedge at this point because London spot silver is still more expensive than New York silver futures. So hedging makes them lose money de facto. Therefore, they cannot do it. And that is one of the reasons why the silver futures market seems to be in a little bit of a breakdown.
Physical silver did not get sold. It was paper silver. It was futures. And we know this because I believe more than 25 groups, over 200 accounts in China at Shanghai got closed down because they exceeded the position limits. And you can 100% be sure that position limits were exceeded on COMEX with no ramifications. There's been no ramifications for the 50 years that COMEX has been suppressing the price of gold and silver. We have proof out of China that futures were dumped. It was an operation to knock the price down. The big story in silver is the physical demand. There's demand from all over the world for so many different uses, technological, medicinal, all the Green New Deal, solar panels, etc. The physical demand for silver is not letting up. Shanghai is at about a $10-12 premium, and India is about a $4 or $5 premium over COMEX. The problem is COMEX cannot mint or print physical silver. And when all is said and done, the COMEX price is going to have to align with India and align with Shanghai. Yeah, I mean, there's just the way it is right now, it's offering an arbitrage to buy it in New York and to sell it in Shanghai. The reason the arbitrage is not being done is because if you sell in Shanghai and you don't get delivered to in New York, now you've got basically a naked short position. So a lot of these arbitragers are not doing the arbitrage because they're not 100% sure that they're going to get the metal that they're buying in the West. Right now, there's over 200 million ounces still open interest, with only about 100 million ounces to deliver. And if that number comes in even close to 100 million on Friday, that basically speaks for all the inventory. If it fails to deliver, the entire system will implode. The derivatives edifice will collapse because silver will spill over to gold, and gold will spill over to the credit markets, U.S. Treasuries, etc. So if silver fails to deliver, it is not an isolated event. I mean, if they fail to deliver, yeah, absolutely, yes. It's the end of the COMEX scheme. And I just posted a couple days ago, I posted a press release from GATA from 2017, where there was an intercepted cable that talked about the futures markets. This was back in 1975. The future markets for gold and silver were created to suppress the price. Well, we've already been through the early stages. Silver has already outperformed. I mean, the silver to gold ratio was at one point 120 to 1. It's now 57 to 1. And what that tells you is that silver, from that point of 120 to 1, has outperformed gold 2 to 1 price wise. And I think we've got much further to go from 57. I mean, I could see it trading down to 20, 25, no problem. And that would be more than another doubling of silver performance over gold. The dollar's already reacting. Gold and silver don't go up or down. They don't do anything. What changes is the perceived value of the currency, or in this case, worldwide, the fiat currencies versus gold and silver. And they've gotten destroyed. I mean, you go back just a couple of years ago, gold was what, $2,500? Now it's over 5,000. So that tells you that the fiat currency, the dollar, has already dropped 50% versus gold just in a couple of years.
The silver market is currently witnessing a historic technical divergence that signals a massive structural shift in global finance. Producer gross short positions have collapsed to their lowest levels ever recorded, a trend that persisted even through recent market volatility. This aggressive reduction in short interest indicates that the institutional forces typically responsible for price suppression are losing their grip as the market transitions into a major short squeeze. Simultaneously, the gold-to-silver ratio is showing signs of a significant revaluation. While the ratio recently spiked to extreme levels, the underlying data suggests silver is poised for a doubling of its performance relative to gold. The true driver of these movements is not the intrinsic change in the metals themselves, but the rapidly shifting perception of the United States dollar. As the currency's perceived value continues to erode, tangible assets are reclaiming their status as the ultimate store of value. Let's get back to the interview.
The dollar will ultimately go to its intrinsic value, which is zero. And what does that make gold or silver, quote, worth? The opposite of zero is infinity. I mean, a cup of coffee could be $100,000.
Yes.
Who knows? But what it means is we're going to live through a hyperinflation for the ages. If you have contracts, if you have any type of contract, any type of paper, silver, you need to turn it into physical metal and have it either delivered to yourself or to a vault.
Okay.
And yeah, I mean, if you have extra capital, you want to get that capital out of the system. And the way to do that is to buy gold or to buy silver and have it in physical form, very close to your control. Well, you obviously want to focus on how much is standing for delivery this Friday, which would be, people watching this would be the previous Friday. If that number even comes close to 100 million ounces, that's the inventory. And what we've seen in these COMEX delivery cycles is you have X amount standing at the beginning of the month. By the end of the month, it might be 1.5 or 2x. It might be 3 or 4x. You need to keep an eye on what stood for delivery this coming Friday, or will be the past Friday. How much is standing versus how much inventory. That's going to tell you whether it's this cycle or a future cycle. I can't imagine it could be more than 3 months. The next big delivery cycle after this one. That's simple. There's more demand, and there's less inventory to meet that demand. Where's the best place to hide? And by definition, that's gold and silver. They can't default. They cannot bankrupt. They've been diluted by these contracts, but when the COMEX, LBMA, when they fail, the way to close those positions out is to buy, not to sell, because it's prevalent. Those are the two markets where the prevalence is to short sell silver, short sell gold, but not have the gold behind it or the silver behind it. So really, I mean, your safe haven is to get out of paper markets, get out of a position where you have a broker between you and your money, a bank between you and your money, an insurance company between you and your money. You want your money close at hand, and by definition, gold is money. Silver is also money, but there's all kinds of industrial, technological, etc. uses for silver. So silver, the problem with silver is there's no huge stockpiles. The central banks around the world have huge stockpiles of gold. There are no huge stockpiles of silver, and silver gets used. So that's the flashpoint. And you can add to that it's a teeny tiny market compared to gold, dollar-wise.
Last chart here, we can see that gold has gone from about 4,400, the low here after the crash on January 30th or February 1st, whatever it was. We hit a low of about 4,400 here, and this bar over here. This is where open interest was at that low. It was at about 430,000 or something like that. Now we are down to about 409,000. This says 411, but it's 1 day behind. I think the new numbers are 409,000. So basically, the gold price has gone from 4,400 to about 5,200. Now it's about 5,100. Still a big climb from 4,600. It's about $500. While open interest in gold futures has gone down from about 430,000 to 409,000. So we've had a big move up in the gold price, while open interest falls closer to the 400,000 level. If you have open interest going down and the price going up, that is the definition of a short squeeze. Doesn't mean that people are stuck, but it means that shorts are covering at higher prices on net. So we are once again in a minor gold short squeeze.
The long-term trajectory of the United States dollar is fundamentally tied to its intrinsic value, which many analysts argue is ultimately zero. As fiat currency continues its inevitable devaluation, the logical inverse for tangible assets like gold and silver is a move towards significantly higher valuations. We are currently witnessing a period where a simple cup of coffee could nominally cost a staggering amount of currency, reflecting not the increased value of the coffee, but the total collapse of the paper dollar's purchasing power. This systemic erosion is driving a historic migration of capital into the only assets that cannot be printed into oblivion. Recent market data provides a clear technical confirmation of this transition, specifically through the lens of gold's price action and open interest. While the price of gold climbed aggressively from $4,400 to over $5,100, the total open interest in gold futures simultaneously declined to approximately 409,000. This divergence, rising prices alongside falling open interest, is the classic technical signature of a massive short squeeze. It indicates that institutional short sellers are being systematically forced to exit their positions at record high prices, removing the primary artificial ceiling that has suppressed the market for decades. Share your thoughts in comment section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive Precious Metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.